Hi, my name is Dr. Annette Moultrie, and this is Accounting 101. So, let's see what we will teach in this video. But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Click on the notification bell so you'll be notified of upcoming videos. Also, please share this video. Here is part 2 of chapter 3. Part 2 of chapter 3, the adjusting process. We will begin with learning objective 3.3. Learning objective 3.3, explain the purpose of and journalize and post-adjusting entries. The end of period process begins with the trial balance. The unadjusted trial balance, it is incomplete because it omits various revenue and expense transaction in the account balances. Accrual basis accounting requires the business to review the unadjusted trial balance and determine whether any additional revenues and expenses needed to be recorded. So they ask the questions such as, are there revenues that Smart Touch Learning has earned that haven't been recorded yet? Or questions as, are there expenses that have occurred that haven't been journalized? So the unadjusted trial balance lists the revenues and expenses, but these amounts are incomplete because they omit various revenue and expense transactions. Adjustments are needed to properly measure several items such as a net income or a net loss on the income statement, or assets and liabilities on the balance sheet. So what are adjusting entries and how do we record them? Well, adjusting entries are made at the end of the accounting period to record revenues to the period in which they are earned and expenses to the period in which they occur. Adjusting entries also update assets and they update liability accounts. Again, they are needed to properly measure items such as a net income or a loss, assets and liabilities, and the two basic categories are deferrals and accruals. And we'll talk about deferrals and accruals in our next slide. Now, again, I said that there are two basic categories of adjusting entries, deferrals and accruals. So in a deferral adjustment, the cash payment occurs before an expense is incurred, or the cash receipt occurs before the revenue is earned. Deferrals defer the recognition of revenue or expense to a date after the cash is received or paid. Accrual adjustments are the opposite. An accrual records an expense before the cash is paid, or it records the revenue before the cash is received. A deferred expense is an item paid for in advance by the company for the use in the future. Now, such payments are considered assets rather than expenses until they are used up. When the prepayment is used up, the used portion of the asset becomes an expense via an adjusting entry. Types of deferred expenses: prepaid rent, office supplies, depreciation. In our next slide, we're going to show an example of prepaid rent. Remember in Chapter 2, one of the transactions, I believe it's transaction 10, the company Smart Touch Learning prepaid for 3 months office rent. They paid $3,000. That's $1,000 per month on December 1st. So after posting, prepaid rent has a $3,000 debit balance. Okay. So here you see on December 1st, the journal entry that is made is a debit to prepaid rent of $3,000 and a credit to cash of $3,000. So as of December 31st, prepaid rent should be decreased for the amount that has been used up. The used up portion is 1 month of the 3 months prepaid, or you can say 1/3 of the prepayment. So prepaid rent has a $3,000 balance on December 1st. As of December 31st, prepaid rent should be decreased for the amount that has been used up. Recall that an asset that has expired is an expense. An asset that has expired is an expense. So the adjusting entry transfers $1,000 from prepaid rent to rent expense. So how do you get that $1,000? It's the $3,000 times 1/3, or 1/3 of that amount. So here you see prepaid rent is an example of an asset that was overstated prior to journalizing and posting the adjusting entry. Office supplies. The December 31st unadjusted trial balance for Smart Touch Learning shows a balance in office supplies of $500. That's the unadjusted trial balance, okay, on December 31st. Now, this represents the amount of office supplies that were purchased earlier in the period. So let's assume the ending balance of supplies is $100, which was found by counting the office supplies on hand at the end of the month. Now, since there are only $100 of supplies left on hand, the company has used $400 worth of supplies. And how do we figure that out? We found that by taking the $500 beginning balance minus the $100 ending balance. So this would mean that the current office supplies balance of $500 is no longer a fair representation of the amount of office supplies that Smart Touch Learning currently owns. Therefore, the adjusting journal entry is needed to properly report the correct balance of office supplies on the balance sheet. The December 31st adjusting entry updates office supplies and records supplies expense for November and December. Now, after posting the adjusting entry, The December 31st balance of office supplies is correctly reflected as $100, and the supplies expense is correctly reflected as $400. The office supplies account then enters January with a $100 balance. If the adjusting entry for office supplies had not been recorded, the asset would have been overstated and supplies expense would have been understated. Property, plant, and equipment. They are called plant assets. Now, property, plant, and equipment represent long-lived, tangible assets used in the operations of a business. Example, you have your land, building, equipment, okay? The allocation of plant assets cost over its useful life is called depreciation. Now, depreciation is a type of prepaid expense adjustment. Plant assets are recorded in full at the time of purchase. Therefore, an adjustment is recorded to reduce the value of the asset over its useful life. The prepaid adjustment for plant asset, again, is called depreciation. The expected value of a depreciable asset at the end of its useful life is called the residual value. Residual value. And here in this example, you remember in Chapter 2, on December 2nd, Smart Touch Learning, they received a contribution of furniture having a market value of $18,000 from this other company, Sheena Bright, who is the owner. Now, the original entry included a debit to the furniture account on the balance sheet and also a credit to Bright capital account. The straight line method allocates an equal amount. It allocates an equal amount of depreciation each year and is calculated as cost minus residual value over useful life. Again, the straight line method allocates an equal amount of depreciation each year as is calculated. Smart Touch Learning believes the furniture will remain useful for 5 years and have no value at the end of its life. The straight line method is used for depreciation. So the cost of the furniture was $18,000 minus residual value divided by 5 because they believe the furniture has 5 life, useful life, okay? So $18,000 divided by 5 is $3,600. That's $3,600 per year. And if you divide the $3,600 per year by 12, you actually get $300 per month. Notice in the above adjusting entry for depreciation, we credited accumulated depreciation furniture for $300 and not the asset account furniture. Why did we do that? Well, first of all, we need to keep the original cost of the furniture separate from the accumulated depreciation because of the cost principle. Now, managers can then refer to the furniture account to see how much the asset originally cost. Now, this information may help decide how much to sell the asset for in the future or how much to pay for a new furniture. The accumulated depreciation account accumulates the depreciation expense. Now, this means that next month, an additional $300 will be added to the accumulated depreciation furniture account, creating a balance of $600, representing what? 2 months, 2 months of depreciation. Now, at the end of 3 months, the accumulated depreciation furniture account will have a balance of $900, and that is $300 per month times 3 months. A business may have a separate accumulated depreciation account for each depreciable assets, okay? However, some companies often have only one accumulated depreciation account for all of their depreciable assets. The accumulated depreciation account is the sum of all depreciation expense recorded for the depreciable asset to date. It is a contra asset. Now, a contra account has two main characteristics. One, it is paired with and is listed immediately after its related account in the chart of accounts and associated financial statement. Two, its normal balance, debit or credit, is the opposite of the normal balance of the related account. Accumulated depreciation furniture is the contra account that follows the furniture account on the balance sheet. The furniture account has a normal debit balance. So, accumulated depreciation furniture, which is a contra asset, has a normal credit balance. Again, the furniture account has a normal debit balance, whereas the accumulated depreciation furniture has a normal credit balance. And again, it is a contra account. Again, as I stated earlier, a business may have a separate accumulated depreciation account for each depreciable assets, or it may have only one accumulated depreciation account for all depreciable assets. Now, furniture account is labeled related accounts and debit column is labeled normal debit balance. The accumulated depreciation furniture account is labeled contra account and the credit column is labeled normal credit balance. The balance sheet reports both furniture and accumulated depreciation furniture. Because it is a contra account, accumulated depreciation furniture is subtracted from furniture. The resulting net amount, which is cost minus accumulated depreciation of a plant asset, is called its book value. The book value represents the cost invested in the asset that the business has not yet expensed. So here we see the book value of furniture. The furniture was at $18,000, less accumulated depreciation furniture of $300, So now the book value of the furniture is $17,700. Now, suppose that Smart Touch Learning purchased a building on December 1st. The monthly depreciation is $250. The adjusting entry would record depreciation for December by debiting depreciation expense building, and it will credit accumulated depreciation building for $250. So here you see depreciation expense building is debited for $250 and accumulated depreciation building is credited for $250. Now, had Smart Touch Learning not recorded the adjusting entries for depreciation on the furniture and building, plant assets would have been overstated and expenses would have been understated. However, after recording the adjusting entries, plant assets are reported at the correct net amount, as you see here on December 31st, the partial balance sheet. The cost principle requires the plant asset account to maintain the cost value in the asset account. However, the corresponding contra account is reported in the asset section of the balance sheet. The plant asset and corresponding accumulated depreciation accounts are netted so that the depreciated value, which is the book value of the asset, is reported properly in the asset section of the balance sheet. Okay, so this is the end of Objective 3, where we explain the purpose of and journalize and post adjusting entries. In our next video, we will continue with the adjusting process of Chapter 3, and it will be Part 3. So we will start with Part 3 of the adjusting process of Chapter 3. Thank you for watching. And please, if you haven't already, please click the subscribe button below.